So in this video, we're going to focus on long-term notes. So chapter 14 is all about bonds and long-term notes. So here in sort of the middle of our lecture, we've so far been talking about bonds. We're going to break it up with a little discussion about long-term notes. Long-term notes essentially represent the same type of thing that a bond does. When it comes to an organization needing a large amount of capital, they essentially have a few options that they could exercise. They could issue common stock, and they would issue that common stock out into the public investing market and receive cash for it. They could issue bonds, and bonds are essentially a bunch of long-term notes that are sort of broken up into $1,000 increments. So you have a bunch of bond holders, a bunch of investors that are holding that bond, and initially they've given the company cash, and in exchange those investors will receive, and the company will pay periodic interest, and then at the maturity period they'll pay off the face amount of the bond. A long-term note is similar to a bond, except instead of going out into the investing market and issuing bonds to receive cash from a large quantity of bond holders or bond investors, a long-term note is essentially where an organization is going to a financial institution to receive a loan. So rather than getting incremental loans from a bunch of bond investors, the company is just going to the financial institution and obtaining the lump sum amount that they need from that financial institution. When it comes to the account names that are going to be used for the organization that's borrowing the money, they're taking out the loan, they would have a note payable. The lending organization would have a note receivable. So these are similar to the terms that were discussed in Chapter 13, except now we're talking about long-term notes payable instead of short-term notes payable. The one other difference between a bond and a note is typically in the way that they are negotiated. So we discussed in the chapters, in the previous videos, the fact that with a bond, there's oftentimes bonds that are issued for either a little bit more or a little bit less than their face amount, for a premium or a discount. The reason why we had premiums and discounts is because there was a time lapse from when the stated interest rate was decided on by the company, right? What is the stated interest rate associated with our bond? And then there was a time lapse between that decision and when the bonds are actually issued in the market. And as we know, markets are constantly fluctuating. So over time, if the market rate of interest fluctuates to then be different than what our stated interest rate is, that creates the situation where we would have bond premiums or discounts, again, depending on how our stated rate of interest compares to the market. That time gap does not typically exist when it comes to notes payable. When it comes to these long-term notes that we would negotiate with a financial institution, that time lapse is not there. So we can negotiate the terms of the note, and when on the day that we sign on the dotted line for this long-term contract, what we can do is create a stated rate of interest that is equal to the market rate of interest. So as we discussed in the previous lecture, in the previous videos, I should say, if the stated rate is equal to the market rate, then that bond, when we were talking about bonds, that bond would be issued at its face amount. That's what we're always going to see when we're talking about these long-term notes. When we're not issuing issuing bonds in an investing market, but instead just going to a financial institution and obtaining a loan, the stated rate is typically always going to be equal to the market rate. So we're not going to have any premiums and discounts when it comes to these long-term notes. So you can see that the journal entries become a lot simpler when we're talking about a note payable instead of a bond payable. For a note payable, on day one when the note is issued, or when sort of the contract is signed, the borrowing company would debit cash and credit note payable. The lending company would debit notes receivable and credit cash. So again, very simple journal entries, no premiums and discounts. If there's no premiums and discounts at the onset of the issuance of the note, then there's not going to be any amortization of premiums and discounts throughout the interest periods. So again, notice very simply every 6 months we would prepare the same journal entry. The borrowing company would debit interest expense and credit cash for the stated rate of interest times the face amount divided by 2. So that's, again, how we got this $42,000. The face amount times the stated interest rate. And in this case, because we have semi-annual interest, we would divide by 2. And so the interest expense and the interest paid is going to be the same each and every period. We're not amortizing any bonds and premiums or any discounts and premiums. So again, the borrowing company would debit interest expense and credit cash. The lender would debit cash, they're receiving cash, and they would credit interest revenue. And then at the maturity period, on the day that the bond, I keep saying bond, on the day that the note is paid off, right? On the day that this long-term note is paid off, the borrowing company would debit note payable and credit cash. The lending company would debit cash and credit note receivable. So again, no premiums and discounts, because at the time that the negotiations are done, the borrower and the lender would agree to that market rate of interest. They sign on the dotted line. There's no time lapse between when the interest rate is selected and when the note is actually put in place. So because there's no time lapse, the stated rate is going to be equal to the market rate, which means we're not going to have any premiums and discounts. So there is an instance where, again, it's a little bit trickier, but nothing that, we haven't already sort of discussed a little bit in previous lectures, is that what if a note is issued in exchange for a non-cash asset? So in these previous examples, what we were looking at was a note that was issued, if I go back to the original slide, a note that was issued for cash. So we were basically just taking out a loan. What if we issue a long-term note and in exchange we receive a piece of equipment or a machine or a building or some other type of long-term property, plant, and equipment asset? How would we account for that? So here's the information that we're going to go through. We are purchasing a labeling machine. So the machine is what we're going to be receiving. In exchange, because we're not able to, essentially what you're assuming is that the company doesn't want to have to pay full price cash right now for this machine. So what we're going to do instead is set up a long-term note payable. That note payable is going to have a face amount of $950,000. It's going to come with a 9% interest rate that's going to be paid semi-annually. The note is for 3 years. And so that's all the information related to the note. Now, the machine. The market value of the machine on the day that we sort of negotiate this arrangement, the market value, meaning what would we have to actually shell out in cash today if we were buying that machine outright, the market value is $902,542. So what we have to do in a problem like this, where we are issuing a note in exchange for a non-cash asset, and notice this face amount of our note is different than the present value or the market value of the machine on that day. So because of that, what we are or what we can assume is that there is a market rate of interest that is sort of implied in the value of that machine, but it's just not stated. We just don't know what it is. So in order to account for this, the accounting for this is going to be similar to a bond, because if we have a present value of $902,000, but we're promising a future value of $950,000 with a 9% interest rate, then we have essentially the same type of situation with where we had issued a bond with a discount. Our note is worth $950,000 and the piece of machinery that we got on that day is only worth $902,000. So we essentially are issuing this note, right, and receiving a machine that has a lower value than the face amount of our note. So we are going to account for this in the same way as we did when we had a bond discount problem. So this is, again, a note in exchange for a non-cash asset. In this case, it's going to be a machine. We account for it similarly to how we accounted for a bond discount. But what we are missing so far is the market rate of interest. We don't know what that market rate of interest is. And so what we're going to have to do is use a rate formula in Excel to figure out what is the implied market rate of interest. If we're given all of these facts in this problem, we can then figure out what the implied market rate of interest is. So if I go over to Excel, if you remember from the debt issue cost lecture, what we said was, in each of these problems, we've always had the same figures. We'd have present value, future value, payment, number of periods, rate, and type. These are all of the things that we've been using in our formulas. If you have all but one, you can solve for the unknown. In this case, the unknown that we're solving for is going to be the rate. We don't know what the market rate of interest is. So we're going to have to calculate that in Excel before we're able to create all of the other journal entries. So again, what we're trying to do here is to figure out what is the implicit market rate of interest, because it's not given to us in the problem, but we have all of the other information that we need to figure it out. So equals rate is the formula that we're going to use. Our number of periods is 3 times 2, because remember, these are semi-annual interest payments. Our payment amount has already been calculated, so if we took $950,000 times 9%, what are we getting today? We're getting a piece of machinery that has a value of $902,542, so that's our present value. Our future value, what are we promising in the future? We were promising a cash outflow, a cash payment of $950,000. Type is going to be 0 because, again, we're making these interest payments at the end of every 6 months. And again, I said before in the previous lecture, for guess, we can just put 0. We don't need to actually include a guess in this situation. It doesn't change the way Excel does the formula. So if we include all of that information, what we are saying here, and again, let's just label this stuff on the side. So this is our future value. This is our payment amount. This is our number of periods, but we had to multiply it by 2. This is our present value, and then our type was 0. If we include all of that information, we're able to calculate that there is an implicit rate of interest of 5.5%. But again, that's a semi-annual. We input all information that was semi-annual. So what we're going to do is just take that and multiply it by 2. If we're asked to come up with what is the implicit annual interest market rate of interest, we would say 11%. That's the implied rate of interest. So now we have all of the information that we need to go ahead and make the journal entries for each of these time periods. So January 1st is the day that we actually obtain the machinery and we issue the note payable. So on January 1st, we're going to record machine, debit, and that machine is worth $902,542. Then we're going to credit long-term note payable, and that's going to be a credit of how much we're promising, that future amount, $950,000. And so what we have, as we had in previous examples, what we have in the previous bond examples is we have a discount on our note payable. So again, normally if we're issuing a note for cash, we're not going to have premiums and discounts. But in this case, we are issuing this note in exchange for a non-cash asset, in exchange for a piece of machinery. So because the machinery is worth $902,000 and we're promising a long-term note of $950,000, we will have this discount in this case. The current value of our note is $950,000 minus the discount. Remember, we look at the note and the discount together when we're coming up with the net value as of any given point in time. And we use that net value to then calculate our interest expense using the effective interest method. So you'll remember from the bond lectures that every interest period we make the same entry, debit interest expense, we credit cash, and then we'll either debit or credit the premium or discount. In this case, we have a discount, so we're going to be crediting that discount on note payable. Interest expense is calculated by taking the value of the bond times the effective or the market rate of interest. And again, we're using the semi-annual form because we're making this interest payment, or we're accruing this interest as of June 30th after 6 months. That's why it's important, by the way, that we calculate that effective interest rate. It's not given to us in the problem, but we need it in order to utilize the effective interest method to account for interest every 6 months. So again, we take the value of the note times the semi-annual market rate of interest. Our cash payment that we're promising every period is going to be the $42,750. And again, if I double tap on that, you can see that the way that we got that $42,750 as our interest payment, $950,000 face amount times the 9% stated rate divided by 2 because it's semi-annual. And then the difference between our interest expense and our interest paid is going to be the amount of the discount that we're adjusting. So we started with a note value of $902,000. We just made this credit adjustment to our discount. So again, as we did with the discount bond problems, we start lower than the face amount and slowly but surely work our way higher. So our new note value is $909,432. If we want to take it one step further and do the next 6-month interest payment, we again on December 31st would calculate interest expense, we would make an adjustment to our discount on note payable, and we would credit cash. Interest expense, as always, is going to be the current value of our liability times the semi-annual market rate of interest. Our interest payment is going to be the $42,750 every 6 months. That's the same payment. And then our amortization of discount, the amount of discount adjustment that we make, is just the difference between the interest expense and the cash paid. Our new note value is going to be the $909,432 that it was on June 30th, plus this credit adjustment that we just made to our discount on note payable of $7,269. Finally, on December 31st, we can't forget about the fact that we are using this piece of machinery and therefore we have to depreciate it. So over time, we're going to record annual depreciation expense and annual accumulated depreciation for our machine. And that depreciation expense, we're going to assume the straight line method. So we take the value of our machine divided by its useful life, again, given to us in the problem of 10 years. So that's the full first year where we issued a note in exchange for a non-cash asset. We received a piece of machinery, and in exchange we issued a note where we were promising to make periodic interest payments and pay a $950,000 face amount at the end of 3 years. Lastly, when it comes to notes, there are also instances where we may negotiate what's known as an installment note. So in an installment note, what we're saying is that instead of waiting until the maturity date to pay off the amount of the loan that we have outstanding, we make periodic payments over the maturity period, over the entire life of that note, and those periodic payments essentially pay down our loan over time. So a mortgage or a car payment. These are different types in the real world of installment notes. Every time you make a payment, a portion of that payment goes to paying down the outstanding principal amount that you owe. And then another portion of the payment goes to paying interest expense. Anytime you have a long-term liability, you're going to have interest expense that needs to be accrued. So again, each and every time we make a payment, that payment is both paying down a portion of our principal and it's paying the interest that we've accrued for that given period of time. We aren't going to go through any examples of installment notes in Chapter 14 because Chapter 15 is all about installment notes. Leases are a prime example of an installment note, and that's what the focus of